All right, guys. That's what I was expecting. Yeah, so not too many of you. But every time I give these talks, I'm a bit kind of wary of giving them, but I think it's important to give them. So I've done this for a bit, maybe like let's say every 2 years for the last 8 years since I started. And I think for me, why I'm giving these talks is because I noticed that for a lot of my acquaintances, a lot of people I know, I see them kind of falling in two different camps with kind of how they manage their money. One is they literally ignore it, and they just like, whatever, money comes in, money goes out, as long as I'm not going bankrupt, and even if I ain't going bankrupt, I'm going to keep doing what I'm doing. And others are obsessed with it. And I'm realizing that a lot of times, even when you are obsessed with it, money actually doesn't, it's a tool that actually there are a lot of people who I think are very well off, did not really find happiness or meaning. And I want to kind of just go through my journey and maybe share with you guys what I normally think that you should know when you start, as soon as you graduate, or maybe even before you graduate from a university. There's a lot of knowledge you gain in university that's very technical, but there's a lot of knowledge that I think is missing that is about the life you're going to lead and kind of the environment you're going to live in, that school doesn't really prepare you for it. I think I've mentioned this in the 353 talks. School, if you look at the terminology, the etymology of the word is, I think it means leisure time. And the Greeks were like, after I toil on the fields and gather my crop, and I fight my enemies and whatnot, and I've got some free time, I'm going to spend time relaxing, thinking about like all kinds of theoretical things. I think in the 1800s, the Germans invented kind of the current schooling system, and it was more invented to kind of prepare labor workforce for entering the industry and being able to kind of operate during the Industrial Revolution. Then I think the school that we have right now is more or less focused on that, kind of like how do we prepare for us to enter the workforce. But it's missing a lot of what I think are important dimensions of our life. The course, what I'm going to talk through is my personal lessons, but I found that at Stanford they teach the CS007 course, Personal Finance for Engineers, and I highly suggest you guys take a look at it, that covers very similar material and actually had the reference to the exact same papers that I was like, oh yeah, this was a reference paper for me that allowed me to understand different concepts. So I really, encourage you guys, if you, maybe I'm not a very good communicator, to just go through the slides available here as you are graduating and you're thinking about what you want to do. So this course is put together by Adam Nash. He's a venture capitalist, and he has a lot of experience with the concepts here. And I have this quote from Bruce Lee. Every time I'm looking at it, I still don't know if it's Bruce Lee or not. So instead of buying your children all the things you never had, you should teach them all the things you were never taught. This is kind of in a way, what I'm trying to do with this. I'm also realizing that I feel this is a bit of a duty for me and kind of as the previous generation to pass on this knowledge to you, because you are going to be the growth engine or the people who are going to raise our civilization status and whatnot in the future. So I'm trying to pass you the baton, kind of like put some of the momentum I have into your journey so you can hopefully go faster. You're going to drag me along when I'm like 70 or 80, like, oh, look what we've built. They're like, yeah, great. That being said, nothing here, I'm not a professional anyway. And caveat emptor, you do your own research, you do your own due diligence. You figure out if I made any mistakes in my spreadsheets. There's nothing here that you can't blame me for doing the things that I tell you I've done. Why is this broken like this? Sorry, I want the slideshow to be full screen. Maybe? Yeah. Okay, and I also, feel free to interrupt me. I ramble a lot. Just either interrupt me by saying something or raise your hand. And on Zoom, hopefully you guys can, I can't see the Zoom chat, so just start talking and I'll listen to the questions or make comments. I know some of you, maybe not here, but definitely some of you in Fizz are way more experienced about this than I am. Like you work with hedge funds and you have extensive experience about how these things work. So I'm not an expert. And I also put references. I try to reference everything I'm saying, so you can click through references to kind of get a better feel for what I'm covering. This talk. This talk I think is the more boring part. This is literally tools to get you to a certain point. It's not why do we choose that point. I think the next talk next week is going to be, from my perspective, a bit more interesting, more creative, more kind of imaginary. What are the different places where you can go? So talk about financial goals. I think this is fairly important. Then income, spending. This is how I think about it. You first accumulate, and then you allocate like funds. And then there's taxes and how you allocate the funds you have into different accounts. It's very Canadian focused, but I think some of you asked about what do you do if you go to the United States. And I asked around some Fizzers. I also asked around some of my friends who are working in the United States, how they manage their finances if they go work abroad. And then I think fairly important to me is like the dangers of working yourself into a system. There's this kind of global capitalist system. So what I'm promoting here is like literally you guys get engaged, interwoven your life and your values with the global capitalist system. There are all kinds of dangers with that. But there's also benefits. So starting financial goals. So hopefully you guys know about early financial independence. I feel like more and more people know about this, FIRE. But back when I graduated, this was not a thing. And I think it was just about starting. Or the internet wasn't around in the same implementation, and I wasn't aware of it until a bit later. At some point, I figured I discovered it, and I started reading about it, and I was like, "Oh, what? You can become financially independent at like within 10 years of like with working only for 10 years. How does that work? Why does it work?" And financial independence doesn't mean you stop working. It means, from my perspective, that you work on things that you like, and when you don't like what you're working on, you can kind of take a break, readjust, reorient, understand what you like and what you don't, and kind of continue. I think nowadays, if you go on YouTube, there are a lot of cyber nomads, people who work at the FANGs that have on the order of a couple million, probably under 10 million. And you can see them just, okay, this year I did this because I liked it. Then I went in Hawaii and I just spent the entire year in Hawaii. I didn't know what I was doing. Then I went to this other place. I started another business with this guy. So they have become financially independent, and they do all kinds of different things. That was actually why I followed this path. More recently, I don't know if you guys have noticed, there's going to be a huge transfer of wealth from the previous generations to your generation. I think this is an article from last year. There's going to be $1 trillion moved from parents to kids in 2026 in Canada. And from my perspective, I don't know how well this next generation that receives $1 trillion knows how to allocate $1 trillion. Most of the time, from what I noticed, and also with I was saying cyber nomads, and this is in IT, in tech, I think there's a lot of, maybe that's why Stanford has the course under computer science, because a lot of the computer science or software people, they make a lot of money really fast. And then from what I'm seeing, the way they allocate that money is literally buying homes, and buying larger homes, building new homes, buying homes in Europe. Like, you can, on Reddit, there's Fat Fire, Lean Fire, Chubby Fire. These are different subreddits with depending on how much money you have. So if a lean fire is like if you have, let's say you've saved about $1 million, you are in the lean fire category. You can retire, but you can't do much. Chubby fire is probably between 2 million to 5 million. Fat fire is probably like 20 million and above. You go to these subreddits, and there's all these people like, okay, I want to buy a house on the Côte d'Azur in France. Should I go here or there? Oh, I bought one there. Maybe you should buy it here. There's all kinds of discussions where I'm like, I don't know if I had that money, I would look just at homes. There's so much more opportunity to use that. So use that value to put it back into society. And my feel is that even some of the poorest people today, they have much more value around them than people, let's say, 100 years ago. And money is not a reflection of that value. It's kind of the interactions that we have amongst us. And I think a lot of times what happens is we kind of give up and we just use this money to kind of accommodate our needs, our pleasures, and we don't think about how can we connect with society better. So this other concept, this idea that there's a lot of wealth that's going to be moved to new generation, and this new generation doesn't have any idea of how to allocate it. This is a big one to me, because my feel what's going to happen is a lot of that $1 trillion is going to just be burnt. Like people will have no idea what to do with that money. They'll gamble it away. They'll more or less destroy it. Again, you can go on these subreddits and you'll see saying something like, hey, my dad or my grandpa gave me $3 million. What do I do with it? And a lot of times people are like, well, you're 18. You have no idea what to do with it. Don't touch it until you get to like 30. You have no idea what you're doing. I've done this before. I lost all of it. So you guys can go through these if you're interested. So originally, I was all about kind of trying to become financially independent and what that meant. I started fairly late. And I hope you guys can start early and you can reach financial independence earlier. Hopefully you guys know some of these things. The biggest thing to me when I saw this was, so why I want to become financially independent. There was this idea of this exponential growth. I knew about it. I knew that I don't understand it well. But there was a number that really kind of captured my attention. There's this idea of, maybe I'll point to the screen so that people online can see too. The amount, so let's say you are saving about $1,000 per year, starting from age 25 to 65, and you invest it in the stock market at 8% or something. The interest made by the savings you made in the first 10 years of life will compound, and they will make more money than all the interests you make from the age of 35 to 65. So if you start early, the money that you save early on is going to have a huge leveraged impact later on in your life. If you start saving at 35, you are not. You've lost a lot of this, having your investments in the market and compounding. And this was the bell that I was like, okay, I should probably start saving as soon as I can. So these are the spreadsheets. So all these numbers that you see here, you can click on the spreadsheets. I try to make them all available, and you can play with numbers. So you can see different values there. So yeah, if you have, like literally invest $10,000 at 8%, and this is how the money compounds. And that, like, you can think about this in an interesting way. Like, if you buy a car for $20,000 when you're 25, how much is that going to cost you by the time you get to 65? So there's all kinds of things. I hope you guys know this the compound interest rule. It's a very simple heuristic. So this is a way to very quickly estimate how fast can I double my money depending on the interest rates. So I chose 8%, and this is, I'm always kind of keeping track of this. So 8% I think is a fairly conservative estimate over the long run. It depends where you look at. In the last 20 years, I think the average return was 9.9%. It fluctuates wildly. This is from 1940s to 2026, I think. Again, like I have this table where I try to pull all the data. But most of the time, the interest that the stock market provides on your investments is, I think, around 12%-ish. Here you can see different classes. Maybe I should point again here. Different classes of investment returns and then the years they happened. So sometimes you can get like very bad returns. This is kind of the Great Depression. And sometimes you have excellent returns here. This is probably like, it's very interesting. This is 1931 and 1933. Immediately after you had a huge increase in the stock market. So I think 8% is kind of a good number. We can talk more about that. I'm gonna go through a scenario here that how when I was thinking about the early financial retirement, how would I kind of try to come up with a model for my income and how soon would I be able to retire? And the way I started, you can guys again go to a spreadsheet. The way I started this was if I have a job right out of university for $80,000, I think this is maybe a bit high. Actually, maybe also a bit low. Depends on where you work. And that job keeps increasing every few years, the salary, and when the tops of the high-end range of my salary is $97,000. And I start saving at the age of 23, and I save about 30% of my income. So 30% of my income means that I'm saving about $27,000, and I live off about $60,000 a year. This includes, it doesn't include taxes. And if you look at this scenario that I have here, by age 42, you should have about $1.2 million saved, and you should be making about $96,000 a year from that investment. And that should be kind of, you should reach the point where now you're financially independent. You have about the same amount of money from your investment as you're having it from your job, and you can kind of look for other jobs, or if you like your job, you can continue there. I'm realizing some of you might not be, you already have maybe some parents or something that can provide these funds. I think it's still important to kind of know about these numbers. This is kind of how things kind of ramp up. Actually, fairly quickly with exponential growth, you can see here at 42, you'll have about $1 million. Before you actually reach 50, you'll probably have $2.5 million. This is very strange. So when you see this in your bank account, you're like, last year I had $1 million. Oh, this year I have $1.4 million. I haven't done anything. And then it keeps going faster and faster, like, okay, what? It feels very unnatural. And as soon as you make more money from your investments than you make from your job, also it's going to feel very unnatural. The flip side is when the market goes down, holy smokes. It's going to be 1 week and you lost 400K. Like, okay, cool. It's just like, we'll talk a bit about that, the psychology of it all. So there's that. So that was a simulation. This was the person that kind of inspired me. And maybe, how many of you know about Mr. Money Mustache? Okay, so 1, 2. So he was from Canada. I think he was from Ontario somewhere. He actually moved to Colorado when Colorado was not very expensive. He was working IT, and he had a blog where he's like, this is how I retired in, I think he retired in it was a bit less than 10 years. And he actually details everything. He's like, how much money I'm making, how much money I'm saving, what are the returns on my investments. And he kind of shows, okay, so he went to Colorado, he was married, but his wife was still, I think, finishing school. This was his income. This was a single earner, and then when his wife joined, they were two earners. And then I think you can see here, they were probably, as a couple, a bit less than $200,000. But they started in 1998, and by 2008, 6-ish, they had enough money to retire. This was their $800,000. And based on their expenses, that was enough for them to say, okay, we have reached our goals. This was very strange because, I don't know if you guys know, in 2008, there was a huge recession, and the stock market went down by 40%. They adjusted their spending rate, and they were able to kind of go through that recession. They were still financially independent. And I think right now he's sitting at about $4 million kind of net value. He's still retired. You can see he's got like all kinds of ventures going. But all of them are him kind of doing all what he wants. So this is doable. I think it's there's a few caveats here. One of them is his house was $200,000. And the homes here, if you are trying to live, let's say, in Vancouver, personal family reasons or not, the home is a huge expense. And it's a huge expense not only that it costs a lot, but you're also not you'll see I've run through some numbers. You're actually not getting the same return on the value increase of your home as you could get from the stock market. So some rules of thumb here. I think my assumption when I'm thinking how much money should I have to retire is that I need to have enough, the full net worth I have is such that I can withdraw from it 5% every year and live off 5%. The 5%, I withdraw 4% of my net stash. Now I'll show you why I think there's a safe withdrawal, and I'm constantly keeping an eye on this, kind of trying to figure out, is this still okay? I think sometimes this 4% is an average value. It's not, so if you see the stock market crashing, you should probably stop trying to use as much money as before. Maybe you can, maybe you can't. But that 4% on average is a safe rule, I think. And there's also this other heuristic here that's very simple. Actually, you can use this heuristic not only to determine how much money you have to save, you can also use that heuristic if you have some business, some venture, should I invest in it or not? So the heuristic here is depending on, if you think about how much money you're using every year, and if you want to be independent, you should have 25 times that amount. And 25 times that amount means that you can make about 5% from your investments without kind of, so you use the interest from the investments and you don't cut into your principal savings. And the same thing with an investment. If you have, let's say you want to buy an apartment and you want to know if it's worth it, you can say, okay, if I rent it out after the expenses, so I have all these expenses associated, if I rent it out, per year I make this much money, is that 25, if I multiply that amount 25 times, is that the value of the apartment? If the value of the apartment is higher, it means that you can probably make more money investing in the stock market than in this. So if you want to figure out if you want to run some numbers, this is a website that you can, again, click on, and you can put all kinds of numbers in here, and you'll see how fast you can become financially independent. This is just playing with scenarios here. Oh, wow, look at that rolling ball. Awesome. Sorry, guys, on Zoom, you can't see it. We have a really nice rolling ball. So why I chose that 4% number. So this has been kind of fairly contentious. How much money can we withdraw without, and if you look at playing out all kinds of scenarios across the last 300 years, would you be able to maintain the integrity of your savings even though you withdraw 4% a year? And there's a guy in Switzerland that actually is keeping this updated throughout the last probably like 10, 20 years. And he runs scenarios where depending on your savings allocation, so this is like, do I have all my savings put into the stock market? Do I have savings put into the bond market? Or I have some ratio? And then you have here you can see like a withdrawal rate. How often, and he looks at all the last 300 years. So if over 20 years, I am pulling out 4% of my assets every year, and I'm living through all kinds of different regimes, what is the probability that I'll still have 100% of my assets saved? So I'm not eating into the principal of my assets. And you can see here that if you are at the 4%, looking at the historical record, you're 100% sure that you will have not eaten into your assets, into your principal, if you withdraw at 4%. If you are fully invested in the stock market, or even if you have bonds. If you withdraw more than that here, so if let's say you draw 10% every year, the probability of you being able to survive with your net assets intact, depending on where in the last 300 years you are, is about 30%. So most of the time you'd have lost all the money you had. And if you want, I'll share the slides, and you can literally click on these things and you can look at. And I recommend you guys, so these are other people who are also fairly financially savvy, and they have their own thoughts on this. So this guy, every year, he releases a new update to this and shows, okay, according to this, these graphs have changed a lot, or not. So fairly interestingly, if you are investing in the bond market does fairly poorly. A lot of times you cannot stay at 4% if you're fully invested in the bond market. The stock market, on the other hand, seems to be more robust. Again, though, remember, when things go down, it's going to look very scary. The other thing I've done, and this is, if you've been to this talk before, you've seen this. I was trying to figure out if you're not an engineer, like somebody who, and engineer, I'm not sure if engineers are doing this right now, but or like you have the engineers, depending on where you work, you are very well paid or not. So you go work in the United States, I think you can expect 100,000 plus salary to start with, and you can fairly rapidly reach, like within probably 5 years. I know multiple physicists who are making probably $500,000 more, or multiple, a handful that I connect with. So these are people who have a lot of income. But I was looking at, okay, how does this look if you actually have the average income? Can this still work? And you can look at my notes here. So I went to Stats Canada and pulled some numbers down. I looked at the average income across different ages for women and men. And I chose what I thought was like, okay, so if you're a single woman, say making the average income for a woman, can you still, if you use these rules, can you still kind of become financially independent? This is you become financially independent regardless of whether you have old age security or not. And the scenario I played with was, I put these numbers in my tables, and I said, if you can save 10% of your income from age 25 to 65, by the time you reach 65, you should have a net worth in excess of $1 million, and you should be making from that more money than you would be making from your job. So I think if you are disciplined, even if you have one of the lower incomes, you can still make this work. And to me, there's a, my wife always says it, discipline is freedom. If you are disciplined, you can be free to do whatever you want. It's a bit of a paradoxical statement. Hopefully some of you will get a feel for this. The important part is you have to be very meticulous. You have to kind of, and it's hard. I mean, sometimes like 10% I won't be able to eat if I need to save 10%. But I think a lot of times it's more kind of like trying to understand what your wants and desires are and controlling those, being a bit more acidic. Anyway, that was kind of a bit of a preamble motivation about what I'm going to cover next. The capstone teams will know that this is a system level diagram. And I put it together for, it was my brother and sister-in-law when they were in high school. And they were like, hey, how do we think about money? And I was like, okay, let me think about this. So what I drew for them was, okay, you can make money in a few different ways. And I have this active income. This is like money you make from a job. And you'll see it's related to how you're being taxed. And then you have passive money. So here you work for your money, and this money works for you in a way if you live in this capitalist system. You make money, then some of I call them taxes. Some of them are actually taxes. Others are more kind of money that are withdrawn from your incoming stream, but they will come back to you. So this Canada pension plan, that's going to come back when you get older. But for my purposes, I'm thinking like for financial independence, I won't consider them. So you pay taxes. Then after taxes, you have your net income. You pay for housing, whatever your living expenses. And then whatever is left is your savings. And you can save them in different ways. You can use different vehicles to invest money with. I think nowadays there's a lot of, I think all banks now have give you access to accounts that allow you to invest. You can invest money through buying property. And this used to be actually a very interesting trajectory to have. I'm realizing probably like from 2008 to probably like 2020, it was probably better to invest in real estate than to invest in other things. Actually, the stock market still did fairly well. The important part of real estate is your investments are leveraged. So you put $100,000 to buy $1 million house, and you're actually making money on the $1 million house instead of just $100,000. But if you had $1 million and invest in the real estate and at the same time in the stock market, if you had that, the stock market would trump the real estate. And I'll show you some numbers. And then the other thing here I was talking to them was invest in all kinds of other assets. Talked about crypto for a while. So I told them maybe not. So these are fairly risky investments. So my focus was on this. But what I'm going to do is I'm going to kind of break this down into different elements here. So first I'm going to focus on active income, and then we'll come around to passive income. So active income, this is more or less kind of from the CS07 course. You'll be, now I'll talk actually at the end of the talk, I'll talk about my experience with a startup and kind of also some thoughts on what happens if you live in the United States. How should you structure your asset allocation so that it's more compatible with you being kind of working in a foreign country, specifically United States. But you could be working for a few different types of companies. So this is kind of, I think, a lot of people were thinking like, hey, Cal, you're bust, I'm gonna go work for one of these companies. I'm thinking maybe something like this is, it's not only a bank, but local companies probably pay maybe on this order. So you'll have some bonus pay, sorry, some base compensation and then some bonus. These bonuses, depending on where you work, might be slightly smaller, slightly larger. I'm thinking this would be kind of like a startup of some sort. And here you can see the compensations here. These are very, I'm realizing this is a starting compensation. And then with Google and all these other companies, they have an incentive for people to level up or move to another company. So they'll give you a very high bonus, maybe so not as an entry employee, not an L3 engineer, but like if you're a bit higher, an L4 or L5, you'll see that you'll talk to somebody, you'll be like, yeah, my total compensation is on the order of 400K per year. But that's only this year. Next year is going to be 360K. The year after is going to be 300K, and it's going to kind of exponentially or decrease until because they get a huge bonus that kind of slows down over the 4 or 5 years. So unless you move to L5 to get a new bonus, your pay is going to go down to like 200K. So they also, I think there's this idea of that you want to kind of keep people kind of on their toes, and you want to motivate them to move up the ladder. A lot of the money you make with these companies is from the shares that are given to you, so restricted RSUs, restricted share units. I'll talk a bit about that later. With these type of normal jobs, you don't get that. You might get higher bonuses, kind of cash, maybe not. With a startup, you actually get this is very kind of high risk situation where if the company does well and you own a fairly big chunk of the company, you can make a lot of money quickly. So 2 million, 3 million in 1 year because the company kind of got acquired or IPO'd or not. The most likely case is that's a fairly gambly situation you position yourself in. I also noticed that quite a few of my friends, once they become financially independent, they actually don't want to work for anybody. And that's because the tax implication of working for somebody, you're paying a lot of taxes on that. So then they just become contractors. And they make a killing as a contractor. So they work for themselves. And they don't have startups either. They just become contractors, like, okay, I'll work 6 months. They work fairly hard, but also including the tax situation, they make significantly more than kind of just working for a normal corporation like that. I realized the job market is fairly tough. I'm going to show you this. This is from one of the fizzers who applied for, I think it was 250 jobs. You can see his approach here. This is not 250. This is just, it ends at the letter J. There were more. He was very methodical on his application process. He ended up working at Robinhood during the explosion with Robinhood trading. He was actually at the center of that. And then he got into blockchain development, not for crypto. It was, you can use blockchain for all kinds of other things. I would say he was an outstanding student. He had all the grades from like, what was it? 70%, 75% to 100%, like every single grade. I do remember he came by in 479 and he said like, I need 79 479 or something like that, like an exact grade. Can you give me that? He was, I think he got like a 90 something. So I know I cannot. And then he took a Japanese course he aced everything. He was like, I know in the final I need to get this grade to get my my full spec. Also, he was he went as a software developer, excellent software developer. Like he challenged. I don't know if you guys know CompSci 320. It's kind of the algorithms course in CompSci. It's one of the harder ones. He didn't take the course. He just challenged the final exam. And then after he passed, and after that, CompSci stopped allowing people to challenge courses because he didn't pay for the course. He was just like, I just want to take the final exam to show that I have the knowledge. So even with that, and you can, these are going to be available. I have no idea what's happening, but it's very hard to kind of get a job. So don't get discouraged. Literally, it's a numbers game. So keep pushing. And a lot of times, I think you can see here, I was applying for everything. A lot of times, I think you have a bit more flexibility. Like you're probably looking for a particular type of industry that you want to work in. Okay, now going back to here. It broke again. Does this work? Maybe? Yes. So I'm going to skip a bit taxes and I'll come back. I just want to talk a bit about spending. And for me, with spending, the biggest thing is that helped me the most is to be disciplined, was coming up with a budget. I have no idea how many of you are using budgets, but if you're not, you should immediately. So budgets are your dashboard for how well I'm doing. So track your expenses. I think a lot of bank apps now can track your expenses every end of every month. They can show, okay, this is how much you spend in grocery, this is how much you spend on this how much you spend on that. I was kind of old school. I have a big spreadsheet. And actually, yeah, since high school, I've been tracking every little thing I buy. I have no idea. I can do a lot of data mining on that. But it's very important to have visibility in how much you're spending. And also kind of keep track of how much you're actually saving. I put here a kind of a budget just to give you a feel for how I think about it. So let's say you have a salary of $10,000 after taxes in Canada, in BC. You have about $6,700 left. And then this is how you allocate. You can kind of somewhat allocate it. So let's say you have some essentials that you're spending. I think these are fairly, I don't think you're thinking about saving if you are spending this much. The kind of here, I don't know if you have a house or not. You pay some sort of rent or you some sort of mortgage, but this is related to housing. Overall, let's say you spend about $5,000 and you save about 12% of your income. If you want to retire early, you have to save more than, like if you want to retire in 10 years, you have to save more than that. I'll show you what I mean by that. So budgets are kind of the compass you will use if you want to reach early financial retirement, or just even not reach early financial retirement. Just think about how you can live kind of in a sustainable way. This doesn't include anything to do with having kids. And I'm going to talk about this next on Thursday. Society is moving in a very strange direction. And I think a lot of these perspectives they are missing important things of what makes us human. And I'm going to cover some of that on Thursday next time. I don't want to go too much into that right now. Having kids is probably, I don't know, on the order of $4,000 a month. Depends on how you are setting things up. If your parents are still around and they can be grandparents and they can take care of your kids, that is probably like worth $100,000 a year, probably more. A lot of times, maybe not your generation, but the generation after you, the grandparents are not going to be around when they are born. They'll have no experience of grandparents. It's a very strange, things are moving very fast, and this is where, I'll talk more about that next time. Anyway, no kids. But I think it's very important to keep track of that. So I actually have in my budget, even though I don't have kids, I have a line for kids. Okay, this is how I'm saving if things would change if I have kids in there. So there's all kinds of apps you can use to keep track. You do whatever you feel like it. You can go on Reddit and look up how do I budget, or you can ask Gemini or whatever your favorite LLM is, and you'll find something. I find that a lot of times, especially now, the capitalist society and kind of our consumerist society, these are two different things. These are tools, but they have been tuned to get us to buy things. And it's actually taking advantage of a bias, a cognitive bias that we have. When we encounter a problem, we look for something to solve it. We look for an additional thing that can solve it. So this is a test. You can see the paper. It was a paper published in Nature. They showed this type of object, a pattern, and they asked people, okay, what would you do to make this picture symmetric? Most of the people said, I'm going to add another box in the corner here. And this is our bias. It's literally how I think about things. But a lot of times I find that I think about it as, what do I subtract from my life to get this problem solved? And Lao Tzu, who is the author of Art of War, it's like to attain knowledge, add things every day. To attain wisdom, remove things every day. My quip about that is it's shorter. The things that I own me. I do not own things. They own me. If I own a house, I literally have to call the plumber to fix that because I don't have time to do it. Every year, I have to get the furnace serviced. I have to do the roof every 15 years. I have to cut the grass or get someone. I have to think about that. If I own a car, actually, electric cars, way better than before. With electric cars, you don't have to think about much. But if you own everything you own, even like if it's a small thing, it's taking volume into your living space, and you have to think about, okay, I have to dust things. So nowadays, I literally don't want to have anything physical. Literally, if you give me a gift, I'm like, where am I going to put this? I have everything I need. To me, it's much more interesting. Present me with new ideas, new kind of ways of thinking. I have no idea if you will encounter this. I think you will. I put a link. I didn't put a link here. There's another CBC article, another tsunami of inherited assets is kind of hitting kids. Nowadays, they're kind of adults. So their parents are passing away, 80 years, 90 years old. And now the kids have to go through their parents' home, and they have to get rid of all this stuff that they accumulate over decades. And it's going to be some, I don't know, China set that my mom bought in the 70s. It cost $10,000. Now I can't, even if I give it for free, nobody cares about it. And it's literally truckloads, multiple truckloads of stuff that you have to take out of your parents' house and just give it to the dump. You might not encounter this right now, but I think probably in 20 years, especially with Amazon home delivery, you will get flooded with all this stuff that you're like, what the heck am I doing with this? And to me, a lot of this is just like we're literally burning resources. Like we are taking resources from our environment, creating these objects, and in 10 years, and I'm looking, so as I said, I keep budgets of everything. I have probably a folder with thousands of subfolders of every item I purchased from when I was in grade 11 to now. And sometimes I go through that and I'm like, wait, I bought this? Where the heck is it? Did I even use it twice? Why did I pay like $200 for this thing? And I'm realizing that a lot of the things you buy, you are just kind of almost tricked into buying it through some very smart marketing. Be very careful with this. The algorithms are getting better and better at capturing your attention and kind of getting you to engage with the system. So spending is, it's a never-ending kind of fight in a way. The way I think also about kind of how I allocate funds is I have fairly liquid funds for some, let's say, half a year or so. I put, before I do anything, like in my budgets, I have, this year I already have it planned. Every month I go like, okay, this is how much I'm spending. If I have travels, I go, okay, I'm going to travel for the month of August. This is how much I'm spending on that. And I in advance, let's say and this is for my own discipline. If I want to buy some new watch or something, I put it, okay, I'm going to buy it 6 months from now. I put it in my budget, and then I see how I feel about it in 5 months, or like as time passes by, and I'm realizing, you know what, I didn't really need that. But so try to capture that in your budget. I think some rule of thumb here is that you spend 50% of your income on needs, 30% on kind of more on wants, kind of things that you think you want. A lot of times I think those wants are not actually needed. Again, they'll crowd your environment. And then 20% you save. This 20% saving, depending on your saving rate, is going to translate directly into how early you can retire financially. So here you can see how this table here, if you save 90% of your income every year, you can retire in 3 years. So that means that you're actually, in order to live, you have to spend 10%. So either your income is huge, or you're saving you have a very good, you don't need to have a lot of expenses. This table again kind of it's another compass I use. And I'm like, okay, so if I save about 50%, I can retire in 17 years. You can look at the money mustache. He was probably saving on the order of 70% to get to retire in 9 years. So again, rule of thumbs here, kind of just look at that and like, okay, so I know. It doesn't mean that you have to do this. And okay, everything I say here is from my perspective. You choose what you want to do. And actually, much more important probably, before you choose what to do, listen to somebody else's perspective. So the other thing that this is also another observation I have is, there are people that earn less than I do and have become financially dependent before I did because they save more. And there are people actually making much more money than I do, and they're still not financially independent. And you'll be like, how the heck can you not become financially independent with $500K a year? And then you realize that they're spending like $400K a year when they actually have saved nothing. And in a sense, your ability to save and kind of be disciplined about saving is much more important than the ability to earn a high income. The earning of a high income is fairly kind of stochastic. You might or might not be able to get it, but the ability to save is kind of more about you. A lot of times, well, you have to spend to live somewhere, so that's you don't consider that. But a lot of times, I think there's frivolous expenses that kind of creep in. And this is I call that kind of this lifestyle inflation. So as soon as you graduate, you're like, oh man, I was living on ramen and hot dogs for the entire undergraduate. Now I have to splurge a bit. And you start splurging and you don't think about it. Oh, you know what? I'm gonna get into skiing and I'm gonna go to Switzerland every year, and then I'm gonna get into some water sport, and I do this and that, and before you know it, you're like, oh, okay, now I'm spending like $100K just in travel, and that it creeps onto you. I'm a bit kind of too detail oriented to get into that. I'm actually spending less and less. It's a very strange thing. Again, just be aware of it. And the other thing here and I'll talk about this right now, is the more you make, the more you pay in taxes. And this is for active income. It's not for income that's coming from investments. I talked to one of the fizzers. I think he's an L7 engineer at Google. Again, this is one of those people who's like making a lot of money. And they were saying something like, yeah, I'm a bit worried about risky investments, but I'm also much more worried about the investments that I did not make. And then he like literally, when he left here, he had like a Mercedes SLK and a Harley Davidson. He sold his Harley Davidson to buy a network analyzer, which was, I think, $30K. And then he built his own kind of waveguide. He's doing all kinds of crazy cool experiments. That's why he's an L7 engineer. But then he was talking about how you should I was telling him, look, I'm going to do this fireside chat on personal finance. He's like, tell the students to save early as soon as they can. And he had this, I quote him, so if you pay $3K per month in rent, over 10 years, that's $550K lost at 8% return. So be very careful, try to save as early as you can. Yeah, live in shipping containers wherever you can. And this is kind of my anecdote there. Now I'll talk a bit about taxes, because this is actually fairly important when you think about returning early, and you can optimize for taxes. This is doesn't mean that you're avoiding taxes. So one thing here, if you look at this table, if you create a histogram of the different type of expenses, you see tax is actually the largest chunk that you would pay. And can you optimize for that? This is the tax brackets, and hopefully you know some of this. I don't know where you are being taught this. This is kind of things that, from my perspective, I was just learning kind of through diffusion. Or, well, at some point I had to do my taxes, and I was like, what do I have to do? And you start looking at numbers, and you have these, you pay taxes in brackets. Hopefully you guys know about that. So you paid no taxes on a certain amount of income, up to, let's say, so this is, I can't remember what the lowest income is, probably like $15,000 or something. And then for the amount of, so let's say between 57,000 and 114,000, for that bracket, for that amount, you pay 20%, and then so on and so on. These are federal taxes, and you have also provincial taxes. If you want to figure out at the highest level what is the total tax that you can pay in BC, depends on the province. In BC, it's you sum these two values up, so 53%. If you make more than probably like $260,000 a year. So this is kind of the background of what I'm going to talk about next. So this is going to be how are you going to invest your money, and everything here I'm going to say is more or less kind of focused on the investing in the stock market, more or less. There's some nuances about that. So if you have active income, you can't do anything about that. So unless you are a contractor. So as a contractor, you can allocate your expenses different ways, and you can maybe reduce your tax rate. There's all kinds of nuances there. But if you actually make income as a salary, and you have a fairly high bracket, you can pay up to 53% in income. In taxes. As an investment, if you, let's say, make $260,000 from investments, not as active income. Somehow I invested very well, and I want to pay that. I want to withdraw every year $260,000. Because it's an investment, the tax code is slightly different. It actually got updated in 2024 bit in BC, or actually in Canada. But the highest tax rate is 27%. And this is because for income, let's say you sell some shares, what you are taxed on is 50% of what are called the capital gains. So it's like how much money did I make between when I bought the shares and when I sold them. And I'm only going to get taxed on half of that. And this is, I think, the government is trying to incentivize the population to just invest in the stock market, and hopefully that's going to create new jobs, new kind of entrepreneurial opportunities, and it's going to grow the economy. And then if you have these investments put into these special accounts, and you probably heard of these RRSPs and TFSAs, you can pay 0% in taxes, depending on what account you're using. And I'll talk a bit about that. So to optimize your tax rate, depending on which accounts you're using and kind of also the financial instruments you're using to generate this income, this is how I kind of perceive it. So this tax-free savings account literally means that whatever money you put into that, when you withdraw it, you're not taxed on it. So if you make a lot of money into that account through investments, you're not taxed on it. Then the RSPs, we'll talk a bit about this. When you put money in, the amount of money and you gets subtracted from your income, and you pay less taxes in the present, but you might pay more in the future. Real estate and I guess crypto and all these other types of investments, they are part of these capital gain adjustments, so you can pay up to 27% in taxes. Then the worst is kind of, if you have a savings account, you should literally right now cancel it and move the money into some sort of one of these tax-free savings accounts, and you can actually invest in probably like the bond market or something like that. Actually, with the savings account, I don't know what is the savings rate, like 1.8% or something. It's like some very small amount. So now I'll talk about these type of accounts. So when you go to the bank, this is literally, I walked into the bank. I was like, okay, I want to open all the trading accounts I can have. And you're like, okay, you can open these type of trading accounts. The most important ones are going to be the RSP accounts and the TFSA accounts. So for those of you who are staying in Canada, you'll see each one of these has different. You can either open it in Canadian currency or in United States currency. So you can have 2 accounts RSP, 2 accounts TFSA, 2 accounts trading. You can have trading. You have trading with margin. So trading with margin means that you can actually borrow money to trade. And all of these can have both US and Canadian currencies versions. Most often, I think, this is when I was looking at my parents, they would put their money in the savings account. And they would pay, when they were working, they weren't paying 50% taxes, they weren't making that much money, but they would pay a lot of the savings went into paying taxes. So instead of them optimizing their savings, with respect to taxes, they would not actually pay attention to that at all. The other thing I was going to say here is that if you are using the banks, there's this national FDIC, I think. FDIC is United States. I can't remember what's in Canada, or maybe FDIC is in Canada. There's an insurance company that if the bank goes bankrupt, they will pay you up to $100,000 for the checkings and savings accounts to cover any losses that you might have. If you have trading accounts, they will pay you up to $1 million. With the trading accounts, whenever I look at these things, if you, I think, are fully invested in the stock market and the bank goes bankrupt, you might lose some money, but you might not. I don't think you lose everything. What happens is, if I own Google, and I own Google through this bank, I own Google. It's not the bank that owns Google for me. So the bank goes bankrupt. What I need to do is find the broker that can move the assets that were on the bank's books onto some other bank's books. And that might be a risk there. I might lose some, I don't know, if the banks are not keeping track, like if it's a fraud, if somebody literally sold my Google shares, then I think I lost them. But if it was just like the bank, like TD went bankrupt, then I don't think I would lose them. So it's becoming a bit more complicated. This was my interpretation of it. You guys do your own due diligence. Now talking about the RSP, so there's actually, I don't know if you guys notice here, I put some notes here. So I said TFSA is actually very good, except if you're working in the United States or you buy US stock. Here, I'll talk a bit about that. So to begin with, I'll start with RSP because this is the older one. So this is my diagram of how it works. You have some income coming in. With the RSP, what happens is you put the money in the RSP, and actually your taxes for the current year actually decrease by withdraw. The government considers that the money you put in RSP, you actually didn't make it that year, so you pay less taxes. But the money goes into your RSP, and you can actually start investing it in your RSP and growing those funds. What you do, though, on the other hand, so this is called tax deferral. Instead of paying taxes right now, you defer them in the future. When you take money out of your RSP, you now have to pay taxes on whatever your total income for the year you're withdrawing from is. And you'll see all these numbers. The cool part of the RSP account is that it is recognized by the United States as a tax-free saving account. So if I invest in US shares, the United States will not deduct taxes from it. All the other accounts are not recognized by the United States as tax-free saving accounts, and you will see, let's say you get dividends, you will see when you get dividends that it's something like the government of United States, NRE, it's a non-resident expense or something like that. It shows up, instead of getting the full dividend, you get 15% deducted, it goes to the United States government. With the RSPs, that's not the case. So the way I think about this, whenever I invest in dividend stock or some sort of investment that provides dividends and is from the United States, I put it in my RSP account. You can also use the RSP to take money out without paying taxes if you are going to buy a home. So there's all these plans that are trying to incentivize or help new buyers of houses, and they use the RSP as kind of a vehicle for saving money there. You can also, if you're thinking about, like, I want to take some course later on, you can withdraw money from RSP without paying taxes. You have to put the money back using this lifelong learning plan. By the time you reach 71, you have to start withdrawing money from the RSP. So the RSP account transitions to what's called an RRF account. You have to start withdrawing. The TFSA, so in the United States, if you go work in the United States, that's called the Roth IRA, different type of account. It was fairly, much more recently. I think the RSP was introduced in the 1970s in Canada. The TFSA was introduced fairly recently. And every year you can contribute a certain amount. I think right now it's about $7,000 a year. And this total amount is probably larger now. This is probably in 2022. And with the money you put in the TFSA, you can more or less do whatever you want. I think as the CRA, the Canadian Revenue Agency, if you start trading daily, they will come hard on you and be like, okay, you can't use it as a trading account. But you could just trade a few times. And if you are very good at trading, you can make literally, I'm not going to name names. There's a billionaire in the United States, I think, in his Roth 401k, he has $5 billion. He just want to show that I can, this is not a good, like, I have this account type, and I can get around all type of taxes by using this account to put my investments there. It was kind of like, let me show you what I do. So this is another type of account. I think all the large banks in Canada, not only large banks, there's all these online banks, they provide access to you being able to open these types of accounts. I'm kind of, I know multiple people that are very careful about how they choose their accounts, and they have accounts with these for trading, accounts with these for savings, accounts for this for checking, and they optimize it to the nth degree. I'm fairly simple. I'm a couch potato, I call myself. And couch potato, if you guys don't know, there's a website, Canadian Investment Forum, Couch Potatoes. You can go there and kind of listen to people. I just keep everything in one place. Go for it, Peter.
About TFSAs,
yeah.
not being able to put American stocks. I remember reading about this, and I'm like sort of confused, but I also sort of came to the conclusion that there are Canadian listed versions of American ETFs that you can buy.
We'll talk about that, yeah. Okay. This is fairly recent. There's been some optimizations done by, and we'll talk about what index funds are and ETFs in a sec, that have been optimized so that you as a Canadian can invest through a TFSA in the American stock market. That's a very good point. So what can you keep in these trading accounts? And a lot of times, so I think most of you are familiar with these things. So shares of public companies, both Canadian and US companies. Actually, what I'm also fairly interested in is other countries. So Korea and Japan have fairly interesting companies. Singapore has some interesting companies. China now, I think, is also coming up on the scene. So it's fairly difficult to trade, and the trading expenses are fairly large, but you can hold not only Canadian and US companies in these trading accounts. Then you have these exchange trading funds or index funds or mutual funds. These are all kind of, I'll talk a bit about this in a sec, type of ways in which you can buy multiple companies at once. Bonds, government, and not only government investment certificates. You can literally buy Vancouver bonds, Vancouver city bonds. They'll have some return. And then more exotic contracts. So these are options, calls, and puts. You can actually buy these on these trading accounts. If you have enough, if your net worth is at high enough level, you can actually participate in IPOs. So I think if your net worth is at least $1 million or you're making more than something a year, you can buy shares that are not actually publicly traded. You have to be you have to have a certain amount of wealth so that the bank considers you as kind of like a more proficient investor. And then the other thing that you can get is research tools. And one thing I like about TD is they have an amazing research tool. Like they call it TD Trading Advanced or something. And you can see the stock markets in real time, and you can get all these heat plots, heat maps, and whatnot. I'm realizing I like it, but I don't actually take advantage of it. Every now and then I go like, oh, let me see this. And I click on it, oh, cool, it looks cool. But I'm a very boring investor. So in undergrad, so when I met my wife, she had this book on her shelf. And she was like, oh, I never read that book, but I think it's an interesting book. You should read it. And then I read this book. This was, I think, a book written in the 70s. And this guy, Burton Malkiel, he made the point that any type of investor advisor in the long run is going to perform, so think about like 20, 30 years, is going to perform less well than the average market. And he was showing how the market is random and it's very difficult to come up with ways in which you can invest predictably better than the market in the long run. So here I learned that, okay, so instead of me choosing stocks to trade, I should look into buying the whole market at once. So these are kind of ETFs and mutual funds that you can use. They're called index funds. So the index fund would buy the entire North American market. So all the companies that are in trade in North America, you buy a small part of them, and that part is going to be proportional to their market capitalization. So whatever, NVIDIA is the largest. Most of the index fund you buy is going to own, and value-wise, NVIDIA shares. So this is kind of me. Even though I learned about this, it took me probably 10 years to really get the feel of it. And when I graduated, I was kind of like maybe with some other people in the similar thought, like maybe some of you have. I was trading penny stocks, I was trading options, I was losing money, I was making money. I was like, oh my God, look how good I am. And then I was like, oh no, I'm an idiot. Took me a while. And then I kind of went into like, you know what, I'm just going to buy index funds and I'll leave it at that. The other thing you can buy is GICs. These are kind of government-insured bonds. I think nowadays they might be okay. They change fairly rapidly in the interest they provide. For short term, you can use them. So for short term, like 2 years or 5 years, you can use them. For long term, I would say probably just buy, this is my personal opinion, the stock market. And I'll talk about the dangers of that. So now that more about index funds, hopefully you guys are aware of them. So here you'll see different types of index funds. So you'll have, and you can literally buy either the entire stock market, or you can say, hey, I want index funds that are related to the health industry. So hospitals and drug and pharma and whatnot, or I want technology, or I want telecom, or utilities. So utilities would be power lines and natural gas pipes and whatnot. They have different kind of behaviors when the stock market crashes. So utilities a lot of times are somewhat decoupled because they have a constant stream. If the stock market crashes, the utilities don't crash as badly. So you can think about how can I invest so that if things go bad, I can still have some income. I'll talk more about that. Things are changing in strange ways because of everybody's investing in investment funds, in index funds. To me, the most important part is when I look at these index funds, and this is kind of a snapshot from one of the, what is it, VO. So this is the Vanguard S&P 500. So this is the largest 500 companies traded in the United States. When I look at, this is the prospectus. When I look at this, what I'm interested in this part here. So this is the management fees. If you go to a normal mutual fund, the management fee, I think, is like 1% or 2% a year. So every year you pay that amount. With one of these index funds, and they are unmanaged, it's just like literally maybe a computer, or there's some algorithm. So when the stock market goes up, it buys, or the prices changes, it kind of reallocates the value so that it reflects the current percentages of the value of the company in the stock market. They have to be a bit smart about it. So they trade in a fairly random fashion so that others, hedge funds, don't take advantage of them. So when you trade, somebody can front run you. They'll know that you want to buy this, and they'll buy it before you and sell it to you at a higher price. But if you trade a bit randomly, or there's all kinds of strategies. I don't actually know them, but the important part is that the expense ratio here is very, very small. So that means that I can use these investments, and I have to pay very little to use them. Here's an example of that S&P 500. This is probably from fairly old, because Apple was only 42 billion. That's not correct. Whatever. So now Apple is probably like 1 trillion. How much is it? Something around that. But you can see. So this is the. Oh no, sorry. This is 42 billion for this particular index fund is owned by. So this index fund owns 42 billion of Apple stock, and then you can see how a lot of this is fairly tech heavy. Apple, Microsoft, Amazon, and you'll see this kind of 80-20 rule. 80% of the value is in 20% of the stock, or even the other way around. So if you're working at Google, a lot of your value from the shares you have at Google is going to probably be in one of these index funds. So you probably want to look into investing in something else. So a lot of times when I talk to people who work at Google, a lot of the things they invest in is Berkshire Hathaway, which is not actually here. Or maybe it's a bit lower down it's decoupled a bit from these index funds. This is how they kind of grow. So in blue you have the actual index fund, and in pink you have the underlying stock S&P 500. So the top 500 companies, their value is moving in pink, and then you can see how the blue curve tries to kind of follow that. Sometimes it's a bit above, sometimes it's a bit below. So this is like the index fund, through its automated system of constantly allocating resources, is tracking the largest 500 companies fairly well. This is all the companies in the United States. This one before was just the top 500. So in the top, all the companies in the United States, I guess Berkshire Hathaway shows up here a bit higher. The other one that I'm interested in is everything except United States. So this is, if you want to decouple, and sometimes today, in today's world, I'm like, holy smokes, United States is going the wrong direction. And sometimes you want to own companies that are not in the United States, they don't work in the United States. The tricky part here to me is that these companies, even though they're listed in the United States, they're international. Like they will move to wherever they think is most effective for them to incorporate. And I think Apple is in Ireland or something. They chose a different, they are a different type of, they are in a different country than the United States, even though everybody thinks about them as US company for tax purposes. So here you can see there's some Asian companies, TSMC, there's some European companies, some Japanese companies, and these are all, you can own these kind of to decouple your income stream from North American markets. Market allocation for this, everything except North America. When I look at things, this is what I look at. I'm like, okay, so today I feel I should not longer be investing the next year in the United States. What am I looking at? And I kind of go like, okay, this has this type of allocation, this is this different type of allocation. And I look at what companies they own, how much they own, and whatnot. So a lot of times, like I could buy TSMC, but to buy TSMC directly, I would have to pay quite a bit. Instead of that, I can just buy this index fund, and then I would get some TSMC in that index fund. Let me talk a bit about real estate, and I'll probably switch a bit tracks. So this is one of the papers that CS007 and myself, we found it kind of independently. I was like, okay, yeah, this is a good course. If they found the same paper, they're thinking the same way as I am. This was a paper published, I think it was 2016 or something like that, by the US Federal Reserve. And they were comparing real estate versus stock market investments, and if one was better than the other. I think from the 70s to now, the stock market has better returns than the real estate. The thing with the real estate is that its fluctuations are a bit more dampened. So the real estate market doesn't fluctuate as much. But from my perspective, there's a lot of headache that comes with real estate. If you own property, you have to think about what the heck is happening. I mean, unless you own forest or something, it's like, oh, there was a flood. Well, okay, the trees are going to figure it out. But if you own some actual home, you'll have to think a lot about that. You could invest in these real estate trusts. So this is like an index fund, but for real estate, that invests in real estate for you. The incomes are probably not as good. This is my analysis, or my personal analysis. And again, you can go to a spreadsheet and kind of play with it. And this was me kind of thinking, okay, so if I invest $250,000 in 2005, and this was kind of, it's probably when you were kids, it was kind of the price of a home in Vancouver, whereas I invested $250,000 in a home. By 2024, this S&P 500 would have been $940,000. And the average price of a house was about $700,000. And this was like an apartment or something. With a house, I didn't include the fact that you have to actually do maintenance for it and you have to take care of it. To me, again, like unless you are the real estate will allow you to leverage yourself. But other than that, I think that the stock market it can do much better than real estate. You talk to a real estate agent and they're like telling you the real estate is the best thing on earth. And this is with the Vancouver real estate market, which is probably one of the better ones out there. A lot of other markets have collapsed dramatically. So instead of this was an apartment, this was a home. So now the difference is 1.4 million versus 1.2. You guys can play with the numbers if you want to try to understand what's going on. So yeah, I haven't subtracted these carrying expenses or not. The Canadian population is kind of changed. I'm not sure how this is going to impact things. There was a huge spike in the number of people in Canada for a while. Now I think it's leveling off. I don't think that's going to affect things. This was me trying to figure out, okay, does it correlate with anything? And maybe it's going to change patterns. Again, you guys can do your own analysis. I was looking at Canada population and analyze growth. If you are thinking about buying a home, this is how I think about it. There's significant additional expenses to owning a home. So Warren Buffett, who's a fairly prolific investor, he said his largest mistake was buying a house. He's like, if I don't know how much money he paid on it, for like $300,000 in 1970s or something, a very fancy mansion. He's like, that house cost me for like hundreds of millions of dollars right now. Again, and I'll talk a bit more about this. To me, living kind of is a part of being human, and how I think about how I want to live is, I'll talk about that on Thursday. Yeah. Okay. If you do want to buy, there's all kinds of different accounts that you can use to leverage kind of your savings. So there's this first home savings account that you can put up to $40,000 without paying tax. So the money you save in there, you don't have to pay taxes for it, and you can use it to buy a home. Actually, one thing, this is a bit of an aside. If your parents, or at some point you buy a home, a vacation home, and you want to give it to your kids, if they have a vacation home, because the home prices have increased dramatically, there's actually a huge issue with kids not being able to afford paying the transfer tax of their vacation property. So let's say your parents bought a home in somewhere on North Vancouver Island, and it was like $50,000. Now all of a sudden it's $700,000. When it gets transferred to you, somebody has to pay the capital gains from $50,000 to $700,000. So you have to pay capital gains on $650,000. So you have to pay about 25% of the value of the home. And kids don't have money to pay that. They have to sell the home, and then they get the money. So because home prices have gone up so much, from my perspective, when I think about a home to purchase, I think about it as a business. When a home is like $1 million plus, I have to think about it not as a home, I have to think about it as okay, I'm going to start a company, I'm going to put the home on the name of the company, and I'm going to use that company as a vehicle to move the home around. Before, the home you could use it to live in, but now a lot of times homes are used as investments, and I think the government has not actually modified any of the tax code to accommodate for that. And if you want to be efficient with your investments, I think you have to actually literally think about the home as an investment and like treat it as such. Otherwise, you're paying like through your nose. So the primary home, when you sell it, you don't have to pay tax on it. But any other home you own after the first one, you have to pay taxes on any kind of transfers. And when I look at homes, again, this is me kind of how I look at things when I try to invest. The interest rate that you pay to the bank is directly proportional to the bond interest rate, the Canadian government 5-year bond interest rate. And I literally open this link that I put here, and I kind of like, hey, how did the interest look like, and how was it impacted by different events? And this is the interest rate, and you've probably noticed that the interest rate for homes was fairly low until 2020. COVID came by, there was some inflation. Canada increased their federal interest, like Bank of Canada interest rate, and then all the interest rates went up. I think more importantly, this is when I look at how did the landscape of interest rate look over what I would consider like a professional life. So over 30 years, if I started my work right now, how would the interest rates vary? Looking to the past is not actually a predictor of the future, but this kind of gives you an idea of, well, interest rates were much higher before, and we went through kind of this low end, we might go higher. So be careful how you leverage yourself. So the leverage is like, yeah, you can make a lot of money, but if interest rates go up, you can also lose a lot of money. So that was the real estate. Some other thoughts here on savings and investing. This is from my painful experience of where I was trading. Instead of buying index funds, I was literally trading, and I have multiple shelves of books where I was like, okay, I'm going to read about this, and I'm going to trade that, and I have like trading options, all kinds of algorithms, and I'm going to do that. There's so many other people much smarter than me that are trading that I'm like, but there's kind of two types. You can do an analysis of a company, so this is fundamental analysis. You look at what are their revenues, kind of how are they investing their money, how are they allocating it, what are the profits, then kind of look at their industry and say, okay, I think they're going to go up or down, and kind of trade on that. Or you can have some algorithms trying to predict patterns in the stock market. Okay, this is an inverted candle, and and you trade on that. Yeah, I paid quite a bit to learn that lesson. I'm not smart enough. So now I just invest in, not only I'm not smart enough, I also don't have, if I have a current job, I don't have time to constantly look into this. So there's some of my coworkers, literally at lunchtime, that's what all they did. They would go to, and they would actually wake up at 6 a.m., trade, work, lunchtime, trade again, come, and then they would continue the cycle. So you have to actually put a lot of effort into getting this to work. So originally I thought fundamental analysis is kind of the way to go. This is Berkshire Hathaway, Warren Buffett is looking very carefully at how to invest. There are some extraordinary investors doing technical analysis, kind of trying to understand how the patterns in the market kind of change. And this is very much machine learning. It wasn't called machine learning back then, but these guys are all quants, mathematicians, and you can see the the returns these guys had. This medallion one, hopefully Jim Simmons, maybe you've heard of him, 71% per year, 1994 to 2014. This is a $10 billion fund, and it's capped at $10 billion, because otherwise they'll become so large, they'll be taking over the market. So every year, and it's only meant for the people who work in the fund. So only those people can invest in it. It's a very interesting kind of world out there. Other type of investments. So Dylan and me can talk at great lengths about crypto. I'm going to say, from my perspective, crypto didn't go in the direction I wanted to go. I thought it's going to go, and right now it's a very well, efficiently tuned. This is my personal opinion, more or less Ponzi scheme. There's a lot of good traders there that know exactly how to play you, to pump you, to put money in and then take all the money out. It's a very well-tuned machine, very effective. Back in the day, the founders of Ethereum, I remember we went to one of, they were just as they started, they gave their presentation of how they think Ethereum. This is a basement in downtown Vancouver. It was just 4 of us, or 7 people. They're talking about how we think Ethereum is going to take over the economy. None of that panned out, unfortunately. We'll see how things move. I still believe in the blockchain technology, so I'm still a very strong believer. It's just that the way that it's currently used, it's not. I don't see it. Options trading, maybe Wall Street Bets on Reddit. I'm not sure if you guys are there. That's how the smart people trade. So instead of trading on the actual stock, they trade on a derivative of the stock. So this is they will place a bet that the stock is going to go high or low, and they leverage themselves, and they can make much more or lose much more. Regards. I think there's other streams of kind of income. I've listed some of them there, but I'll leave it at that. My underlying hypothesis of why this works, why investing in the stock market and kind of this works, is because I have this intuition, and it might be working or it may not. There is an underlying value to the economy. Through technology, we are creating value in the system. And the stock market is somewhat reflecting that value. Sometimes the stock market is overshooting the actual value of the market, the underlying value of the system. Sometimes it's undershooting it. But on average, it's kind of keeping track with the value that's happening here. And to me, that value is literally through technology. Now we have drinking water. Okay, now all of a sudden we have fast transit. Now we have communications. That is value that's added to our system, and the stock market is capturing some of that, and I'm kind of partaking through investing in it into that growth of value. Wars can destroy that value. But if you look at how the economy kind of progresses, the economy is kind of like a living thing. It adapts itself. It's going to kind of go back and keep growing in a way. We'll see. I have way more to say about this and kind of in a planetary setting. Now let me talk about dangers, because I think this is fairly important. This is some of the lessons I learned. So the market is random. It acts in very strange ways. It's asymmetric. Some people know about things way before you do. Some people have better ways to predict things than you do. There's a lot of friction in the market, and a lot of traders, they want you to place trades just so they can take a bit of every time you place a trade, they take a bit of a profit on that. And they will try to incentivize you to trade. Play against professionals. That's what I do every day in, day out. There's going to be professionals in Eastern Europe that I know of who are really good, the brightest mathematicians I know. It's got all kinds of different behaviors where if you think the market is going down and a lot of people think the market is going down, it's reflexive. It kind of starts going down and then it responds to itself. And I'll talk a bit about this. A lot of the companies are actually disappearing from the market. So there's fewer and fewer publicly traded companies. A lot of the companies are becoming privately owned. And that means that the commoners don't have access to this growth in the value of the economy. And sometimes people say the market is efficient. Depending on the zoom level you look at, it might or might not be. But most important, I think, from my perspective, we are not rational. And we are not rational in a very technical way. These are all kinds of ways in which we are not rational. We are maybe sometimes predictably irrational. We are more or less random. Sometimes we are irrational in the same way, so you can actually use that pattern to do something about it. And maybe you've seen this. I think some of you have seen this lecture before, so you know this. This is Isaac Newton investment kind of pattern. There was a company, the South Sea company, the 1700s. I don't know exactly. They were trading with India or something like that, or they're trying to trade. And people are investing in anything like it's going to go to the moon. And then this is the price, the stock price of the company. And then, okay, this is Newton invested a bit. And then he's like, oh, I was so smart. Look how much money I made. And the price keep getting higher and higher and higher. And then I guess Newton didn't have the discipline. He just fell prey to his emotions. And he's like, hey, I'm going to go all in. So he puts money in here, and then he kind of exits when the stock fell. There's all kinds of patterns that develop. But to me, whenever I look at these things, if I feel things don't make sense, if I don't understand them, even if they're extremely valuable, I'll just ignore them. And it's a very strange feeling. It's like, holy smokes, look at those people, how well they're doing. And I'm sitting here kind of on my own, and I don't do anything. Some people say that the markets goes boom and bust every 10 years. These patterns have disappeared. They have been mined away by traders, and I'll talk a bit about it in a sec. The time in the market is way more important than timing the market. And this is kind of like a trend just to see how people invest in the market and how the market price fluctuates. So the important part here is you want to trade, you want to buy when the price is low, and you want to sell when the price is high. Now, if you look at this pattern, okay, the price is high and it started to fall, and people are buying. So when the price is high, people are buying. When the price is low, people are selling. They're doing exactly the opposite of what they're supposed to do, and they're doing it consistently. They're very good at losing money. There's a student or somebody who I was talking to is like, how fast can I lose $100 when I trade? And that was kind of like a valuable index. So here the idea is you want to ride this trend. The market is increasing in value over the time, and you don't want to kind of try to, in the moment, be like, okay, you know what? I know exactly this is going to happen. And if you have insider information, you can probably make quite a bit of money, but it's very dangerous. I really like this one. So it turns out somebody did an analysis of accounts, and they figured out that people who are dead have the best record on investment. And that's because the people who are dead can't trade, so they just keep their money in the market. The next one over, I think it's women. So women are much more careful about, so they kind of consider the trades much better than men, and they don't trade as often, again, and they make good returns. Then here you have all kinds of other people. Average investor, 4%, okay, these guys are going crazy. To me, like if Armageddon's coming, you buying weapons, and that doesn't work. You'll have way different types of problem than that. And so I'm from Eastern Europe. I lived through kind of the Romanian communist revolution when the whole country kind of collapsed. It's not as bad as you think if you have a good set of neighbors and everybody's kind of knows each other and you have a good community. it's actually much smoother than it's presented on the news. The news is presenting things that are very bad at the particular location. Overall, the situation, the communities kind of take care of each other. So in the end, I think in the long run, don't fall prey to the immediate emotions. So these are some dangers. So I talked about how there's fewer and fewer companies. There's this market consolidation. So before I was buying index funds because I wanted to be as diversified as possible. I want to buy something in agriculture, also something in tech, also something in, I don't know, the oil industry or something in healthcare. I wanted all these companies when the oil industry is doing well, maybe the healthcare industry is not doing well. So my average investments are going to do on average kind of maybe still okay. But because the market is consolidating, all the companies are now being owned by fewer and fewer companies, everything is going to start moving in lockstep. And this is, to me, it's kind of a fairly, it's multiple, it's moving in lockstep because of multiple reasons. So one of them is this consolidation. This is a trend. So you can see here from 1996, this was a peak. You had about 8,000 companies listed in the North American stock market. Now there's about, I think it's less than 3,900. I didn't know about this. At one point, I received a letter from my trading account saying that we were not able to satisfy our contractual obligation of maintaining at least 4,000 companies in this particular index fund. And I was like, what the heck does that mean? And I started looking and I was like, oh, there's no longer 4,000 companies that these guys can buy. And then I was like, hey, how does that impact me? I don't know how that's going to pan out. That's just one thing to think about. So I have this number here. There's about 6.1 million ventures companies in the United States, and less than 4,000 of those are publicly traded. And a lot of these now are in private hands. So you think about SpaceX, for example, or something like that. SpaceX is going public, but before it actually going public allowed to have a lot of money coming in to use it to grow. Nowadays, you don't actually need that to go public to get that. Like you look at OpenAI or Codex or all of these guys, they need $2 billion. There's going to be private investors that are going to give them that money. They don't need to IPO. So that particular section of the economy that grows is going to be limited only to those people if it grows. This is another thing. So every year I kind of look at this chart. So this is different sectors in the economy and how well they are correlated with each other. So the US stock market correlated one with itself. So it correlates it's perfectly correlation. The foreign stock market correlated to the US stock market. They're fairly highly correlated. Originally, so this is 2021, you can see that the bond market was inversely correlated with the stock market. That meant when the stock market would go down, the bond market would go up. So if you are owning both some stocks and some bonds, on average, you would not lose money, or maybe you don't lose as much money as others if the stock market went down. But through index funds and it's not only index funds, it's kind of large sovereign wealth funds. So these are entire countries have their own index fund. All these different industries, asset classes, get connected to each other through people owning them together. Go for it.
How long is the correlation window in time?
I think this was they were probably like a year. I don't know. I can look into exactly the source here. But so I have it in 2021, and then I have it again in 2022. So it's probably less than a year. And then you can see all of a sudden the bond market is no longer inversely correlated to the stock market. When the stock market goes down, the bond market goes down. Then I'll have it again for 2024. The trend continues. And to me, this I understand why that happens. If I own both the stock market and the bond market, the stock market goes down now, and I need money. Now I won't sell my stocks because I would make a loss. I'm going to sell my bonds. And by selling the bonds, the bond price is going to go down too. So now through me as an individual investor, and it's not going to be me personally, it's going to be like literally Sovereign Wealth Fund of Norway, $1.2 trillion. They have to pay their pensions or whatnot. They start coupling these different type of assets together. So before you would invest in different type of asset classes to make sure that if something goes bad, you can stay kind of liquid. You can have enough funds to traverse this period of kind of crisis. Now it's a bit difficult. So there's no way to kind of get around this. This was, some of you might know about this long-term capital management. There's a few Nobel Prize winners create their own hedge fund, and they were arbitraging bonds spreads. So they're looking at a certain type of bond. They're like, okay, in the long run, this bond should have the same price as this other bond. We'll buy it when it's high, we'll sell it when it's high and buy it when it's low, and hopefully over the long run, we'll make our money. This was the first time when the U.S. Federal Reserve and the U.S. Federal Reserve, there's the Bank of the European Central Bank, and then probably like the Chinese Central Bank. These are the major players in the world. But this was the first time when the U.S. Federal Reserve stepped in and bailed out a privately owned company. And this was the whole thing about privatize the gains and socialize the losses. This happened in 1998. This is a very interesting book to read because there are so many smart people here, like literally Nobel Prize winners who were like, oh yeah, we know what we're doing. And then they started losing money and they started losing money some more. And they were like, okay, if we go down, the US economy goes down. And then they went to talk to the US Federal Chair and they're like, okay, we have to do something about this because if we unroll our trades, everything's gonna collapse. And the US Federal Reserve kind of was like, okay, we'll bail you out. And then that pattern kind of repeated whenever things were going bad for these kind of financial institutions. The US Federal Reserve, and not only that, ECB, the European Central Bank, and all these other big banks were bailing these corporations out. And what it means by bailing out, it means that they would, and I'm going to talk about this on Thursday, they would create money out of nothing and buy the assets of these companies. And that would result in, so this is, you can look at the assets owned by the Federal Reserve, for example. So in 2008, when the crisis, the housing crisis happened, you can see how the assets for the Federal Reserve went from $1 trillion to $2 trillion. And then again in COVID, it went from, and then what the Federal Reserve is trying to do is it's trying to undo this purchase of assets, sell it back to the market, hopefully because the market has increased in value and these assets also increased in value. COVID comes, they go from $4 trillion on their books to $7 trillion. Then they go to $9 trillion in 2022. So this is them literally creating money out of nothing and buying these assets, and this is going to keep the value of those assets high. So it's inflationary. And then the Federal Reserve is trying to unload these assets. And what's happening here is the market, the amount of money on the market itself, when you have the US Federal Reserve printing money, there's way more money in the market than the underlying value. So the underlying value stays here, and then the amount of money goes up much higher. So now it looks like from the individual perspective, it looks like the price of everything went up. Then what the Federal Reserve is trying to do is like, okay, we are not going to generate more money. We're not going to print more money. We are going to wait. So this is going to stay fairly constant, the amount of money in the market, in the system. And you are waiting for this line, the intrinsic value market, to be able to keep up with this, to bring it up to the actual amount of money on the market. So you have a somewhat a deflationary period. Who the heck knows if this, sometimes it can work. I think Canada is doing okay-ish. The US is doing kind of much worse in the last few years. But ideally, you'll see this kind of spread. You want to have about 2% inflation in the market, and from my perspective, that's because you don't want people to just hold on to their money. You want them to invest. So if you had no inflation, or you had actually deflation, people who actually hoarded money in a deflationary system, and this is like if you look at Bitcoin, you would actually own more value than before. So there's no incentive for you to actually go into the world and kind of try to create value, because you have the money and you're like, I'm just going to hold on to them. And because the economy is deflating, so the amount of money stays the same and the value of the market increases, the money that I have is going to allow me to purchase more. So the central banks, I think in their charter, it says we want to have inflation somewhere around 2%. So if you just put money in your mattress, and this is like in Japan, if you look at, Japan had like a freaking deflationary period for the last 30 years. And the Japanese bank is really trying hard to create inflation. And people in Japan literally took their money and put it at home in like big safes. Now I think they have some inflation, and we'll see. So now they have to take that money and invest it in the economy. This is John Bogle, some quotes from him that I think are fairly interesting. So he was the guy who created the first index fund. This is the Vanguard Index Fund. And he talks about how back in this is 70s or 80s, before you have owners who were owning the capital, now you have managers managing the capital, and also they're setting the directions. And that meant that they run firms in the different ways. They run firms so that they have they incentivize kind of short-term profit. Also, you'll probably see all these plots of executive compensation has gone through the roof. The CEO is making like, I don't know, 200 times more than the actual current, like employee in the company. There's all kinds of interesting patterns here. I think at some point the legislation became very lax. So in the 1930s, when the economy kind of collapsed in the United States, there was very useful legislation that was put in place that kind of minimized the impact of companies kind of trying to take over the system. And in the 1990s, those legislations kind of got canceled in a way, and then the companies kind of took over, and now everything is fairly Wild Westy. Everybody does whatever they want. Okay, so anyway, my summary, and so the next thing I'm gonna cover is the summary, and then I'll talk a bit about my startup experience, and also about the work in the United States. So from my perspective, being able to have very high returns while minimizing risk from a normal person, not even a normal person, it's impossible. The people you see that are making a lot of money, it's probably because they're risking a lot. So risk normalized profits are very hard to, having high profits with normalizing them by risk is very hard to get. From my perspective, I just use index funds as a vehicle to kind of save. It's very boring. I don't do anything. I just, every now and then, I buy some more. This might work for a while. It might not. We'll see how things kind of pan out. Because I think most of the market is now index funds. So there's very few, with index funds, because you own everything, there's very few companies or like very few investors that are now giving the direction of the market. And then the other thing I think a lot is I try to minimize my management expenses, the trading fees, and also the taxes I pay. So then minimizing taxes sounds kind of strange, like, oh, don't you want to give money to the government? In a way, I have my own ways of kind of giving back, but I want to be able to control that. And I have my own interest in how I want my money to be allocated. It's all up to you guys to kind of figure out how to set things up. Yeah. Minimize things. If you have any debt, try to pay that down before you start investing. So if you have any debt that's above probably like 4 or 5%, don't save anything. Just pay down that debt. As soon as you kind of start making some income. I highly encourage you guys to. This is from my personal perspective. You guys check it, but open TFSA and trading account and RSP accounts at least, and then put your savings in there. Yeah, this one I have no idea. Every time I give this talk, something crazy happens, and I'm like, nothing I said here makes any sense anymore. And then 2 years pass, I'm like, oh no, if you invested back then, you'll still be doing well. So COVID, at one point it was COVID, and the market just tanked. I was like, okay, I don't know if you should still invest in the stock market. But if you invested back then, you'd be actually doing very well right now. There's all kinds of books, and I have a section just on books. And I think before you start your journey, you just have to familiarize yourself with the environment. But this is a fairly good book, kind of the psychology of monies. And I actually noticed this. So there's that point there. Wealth is what you don't see. And I'm thinking of all the billionaires I know, and none of them would you tell that like they are in any way rich. They wear kind of not crappy clothing or not, but in any way do they not flaunt their richness. And I see a lot of people who are apparently very rich, and they realize, okay, that's probably a lot of that is on it's either debt or they actually don't have as much as they show. It's a very interesting. So I guess what I'm trying to say is, if you go on Reddit or on the social media, the people you see that you think are rich, those are not the people who are rich. Those are the people who are portraying themselves as being rich. It's a very strange feeling when you actually meet them and you're like, wait, what? And in a way, this is also related to financial independence. And the most valuable thing you have is the ability to control the direction of your ventures. And it's actually the ability to control your time and to work on what you want. That's probably way more important than any type of like money you have. Literally, you could be like penniless if you can live in a house or somewhere and you can eat and then you can do anything you want. That's probably like one of the richest people out there, because they can do anything they want. Like there's all kinds of jokes with like some fisherman sitting on kind of a pontoon kind of fishing, and then some rich guy comes next to him. Why don't you work? Why are you just sitting here fishing? And the guy's like, well, okay, if I was working, what do I do? Well, you do this and then you make a lot of money. And then what do I do with a lot of money? Well, you'd buy a home on the seashore and then you live there. And then, okay, what do I do? Then I would be fishing. Oh, okay, so if I work, I make a lot of money, then I buy this, then I'll be fishing. Why not just go fishing and forget about all this intermediate part? That being said, some of the work that you do, I think, has a lot of, I will talk about this on Thursday, brings a lot of meaning into your life. That, I think, is another very important part, where the work is probably, the meaning is, again, much more important than the money. The money to me is like, if you reach a certain point where you can cruise from there, then you can actually focus on the important parts. A lot of people don't reach that point, and they are just toiling away and kind of trying to make it live, but it's kind of like very strange incentives in the system that keep you kind of engaged in a, I don't know how, I don't want to use, there's certain words that I don't want to use, so I'm not going to say in which way. The other thing is, a lot of people will be saying, oh, things are going worse and worse and worse. And that feels like, and this is there's this part, optimism sounds like a sales pitch. Pessimism sounds like someone trying to help us. From my perspective, being optimistic is kind of paying off. And this is kind of like me saying, I still think that even though the system is going through this crazy oscillations, I still think overall we are going to be adjusting ourselves to create a better value in our society and the environment overall. And then this last one, we desire to live, and this is a very difficult one to accept. We desire to live in a predictable, controllable world, so we turn to authoritative figures who promise to satisfy this need. And from my perspective, you have to respect the randomness of the world. You have to say, you know what, all the promises you're making, you cannot keep them, and I'm going to go, I understand that, and I'm not going to try to put my value in kind of, I'm not going to associate myself with you, even though you promise all these things. I think you've heard me say this over and over again. A good leader is hated by a lot of people because a good leader optimizes overall the entire system. And when you optimize over the entire system, no subcomponent is optimal. Everybody's going to have something to complain about. So it's a strange situation, because a bad leader is also going to portray itself like a bad leader. So a person who doesn't optimize anything from the perspective of a commoner is also going to appear like a bad leader. So both a good leader and a bad leader are going to appear as a bad leader. Does that make any sense? So if you try to optimize overall, you cannot have one particular subgroup being the optimal. Everybody's going to be kind of suboptimal. Okay, so this is the summary of the talk. If you want to take anything away, start early, try to stay diversified, try to save as much as you can in the beginning. It gets easier. If you start saving early, in the beginning it's very hard, but as the time goes on, it gets easier and easier. The other way around is it's very easy in the beginning, and then it gets harder and harder and harder. And actually, you'll have less and less freedom. With saving early, you have, from my perspective, you have more and more freedom. And then reduce frictional losses. So this is minimize all kinds of fees. It's marathon, not a sprint. So now talking a bit about what I call geographic arbitrage of jobs. So working in the United States, working in the United States is the play here. I didn't go over there because I felt coming here was much more, it was much richer for me, and I actually didn't need to go. anymore. But you, as early kind of graduates, maybe going there, and I think it's fairly easy as a Canadian to work there. You need a TN visa, and then you can just work. And there's some limitations there, but I think you can make more money, and if you stay frugal and you stay disciplined, you can probably retire early fairly easily if you work in the United States. That being said, though, I'm very curious how China is going to progress. China is doing all the right things, kind of in a very strange way. They're looking at what are the best think tanks in the United States saying we should do, and the United States is kind of ignoring that, and then China's like, hey, let's do that. Go for this, Cyrus.
I guess this isn't like super relevant. I'm just wondering what the hell is going on with Italy.
I don't know. All kinds of things. If you look at Italy, there's a very heterogeneous country there. So I don't know much about it. The north is doing something, the south is doing something else. Industries, they're very tightly now tied in with the European Union. It's a complicated situation. I don't think there's an easy answer there.
No, that's fair.
Actually, when you look at these things, you don't realize. So, for example, Japan owns a lot of industries in China. You don't know that. It's like, what? So these numbers are not very easy to read. So I talked to some of the fizzers who are now in the United States and asked them, okay, what should I advise the students? The first thing so one of them, actually two of them said was, close down all your accounts that are not that recognized by the United States as a savings account so Canada and the United States has these treaties. And in those treaties, they say, okay, if you have this type of account, both Canada and the United States recognize the saving account. So two of them that left, I remember the year before the year that they were going to leave, they literally had this mad dash of, okay, I have to liquidate all my accounts in Canada, close them down, then move them in this other account. Otherwise, it's a huge accounting hassle to keep accounts both in Canada and the United States. They said in the first year, because you're in this transition year, just hire an accountant to do the taxes for you. Otherwise, it's kind of and if you get on the IRS's kind of bad books, this is the Revenue Service, the CRA equivalent in the United States, things are not going to look good for you. So there's this other thought kind of thing they mentioned. So one of them, they worked in the United States for, 7 years or something like that. And then they came back. They actually saved a lot of money, and they bought property here, and they kind of have a family here. And they said when they come back and they want to transfer their assets from US to Canadian currency, you can lose a lot of money if you don't think carefully about it. So and they're also using the same thing. You can use this, it's called the Norbert Gambit. How many of you know about this? Okay, good. So instead of paying exchange fees to the bank, which are about 3%, so if you need to, let's say, so he bought a home that was $1 million. 3%, $1 million is a lot of money. So you use this particular technique where you buy, it's kind of like a stock. You buy a stock in the US market, then you transfer the stock on a Canadian market, and then you sell the stock on the Canadian market. So you don't have to pay exchange fees. You kind of buy the US stock with US currency, and you transfer it, and then you sell it with Canadian currency. Go for it.
And that's totally legal? Or?
It is totally legal. Okay. These are specific, everything is above board. And the banks have created these vehicles so you can transfer money like that. Over, Matteo.
You not pay taxes on it.
Sorry, you do. That's a different, taxes are, but you don't want to pay 3% on just the foreign exchange transfer. Depending on how you set things up. So let's say this would be in your RSP, then you don't need to pay taxes on that. That's actually a very important point. So when you sell stock, you have to be careful in which type of account it is. If it's in one of these tax-free savings accounts or like in a tax-sheltered account, you can sell and buy without any tax implications. But if you have it in a I guess it's called a trading account, the year you sell stock, you have to make sure that the capital gains you made or the capital losses you made are aligned with your income, because you can have a huge tax liability because you sold some stock to buy some other stock. Ask me how I know. Okay, so those are kind of the two things. So and from there on, it's kind of fairly simple. So liquidate your assets in Canada that are not recognized by the United States as kind of tax shelter accounts. And then when you move money, you can use this the technique. Okay, my startup experience. How should I start this? So I'm a bit of a. So I went through with Boreal startup. I kind of did a few more kind of things, ventures that I was trying to get some other companies started. My current opinion, and maybe I'll do a bit of a historical thing, perspective here. The summary of it is, I don't know if when I would start right now, is right out of undergraduate, if I would try to join a startup. And again, like listen to other people's perspective. My current advice would be for you to join a company that has very effective kind of processes that you can learn a lot from. You spend some time there, you can probably make some money in a consistent fashion. Once you have a bit of a buffer fund, you can think about the startup. And the way I think about these things was I think it was probably like from the 20s to probably the 1960s. There were a lot of big companies there that were hiring people, and they were paying them fairly good wages. Well, on average, everything is kind of very low pass filtered. In the 1960s, there was this boom with semiconductors, and I think a lot of this was the Silicon Valley inception. A lot of the employees at those semiconductor companies realized that, you know what, I could make more money on my own, creating these new devices, new concepts, than working for these other companies. So from my perspective, it's kind of from the 1960s to probably like 2010-ish. This was kind of, to me, somewhat of a golden era for startups. This actually is changing. 2010-ish to probably nowadays, maybe a bit more, companies can pay you significantly more than they can make in a startup. So if you go work at any one of these big companies, so semiconductors or I don't know, Tesla, Google, whatever, Facebook, not only those, there's others, you can probably make 200, 300K a year kind of in a consistent fashion. Over 10 years, you can make probably about $3 million in total. From my experience, the probability of you being able to make $3 million through a startup is very, 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 very low. Most startups, I have a slide here, they don't do very well. And this is kind of my experience too, kind of with the company that we started. Even though we had a lot of very bright people working at the company, there's so many other dimensions that are influencing you that overall, it's extremely random. There's so many sharks out there that are going to try to eat your company alive. So they'll structure certain investment rounds in certain ways that you'll lose all your money very quickly. You have to pay lawyers $1,000 an hour to review all these things, and it's a very, very competitive world. And the probability that you, as one of the first employees, can make money is very low overall. The opportunity with startups is that you would join a company from ground zero. You will very rapidly have to traverse, if things kind of go okay-ish, a vast stack of problems, and you learn things very quickly. If you have a good culture, it's going to be really, how would I describe this? Kind of like a brotherhood. It's very meaningful to work through hard problems with other people and solve them. It's going to give you a lot of self-motivation. You won't actually feel like you're working much. You'll feel like you're kind of developing something with a team of friends. That is not always the case. I was fairly lucky that for me it kind of worked out in some way. Actually, from a compensation point of view, me being in a startup, I was the first employee, I did not make any money. Actually, I think I lost money. Even though the company actually exited successfully. So thinking about, I put 10 years of that, and I was working, 60, 70 hours a week. The money I made of that, I could have probably doubled easily if I worked at a normal company. Not doubled, more than that. So it's even like when you look at Facebook and that is like the 0.01%. It's like you're looking at the cream de la cream de la cream, in, oh yeah, I'm gonna be a billionaire too, or a millionaire too. That doesn't happen most of the time. It's a lot of pain and sweat and toiling, and there's very little opportunity to actually get that back in some type of value that comes back to you. With startups though, this is a few things I learned. So when the company gets started, there's going to be the company's going to be, you'll have some shares, and these shares are going to be allocated. The founders, a lot of times you'll have, the shares are kind of allocated in a few different pools. You'll have the founders' shares that are going to be probably, most of them to begin with, so you'll have like 80% of the shares are founders, then you'll have like 10% of the shares are employees, and then you'll have like a pool of another 10% of shares that you can use for future employees. The founder shares are going to start being diluted every time you raise money. Some of those shares kind of get sold to the investors. And by the time I would say the company is doing, it can, let's say, exits in some way, my feel is that a founder would probably own maybe about 1 to 3% of the company. It totally depends on the company. Like if you look at SpaceX, whatever, Elon is only like 50% or something. And if the founder is very nimble, they can own more. But on average, when I talk to others, it's about 3%. A few of the early employees might own maybe 0.05% of the company or something like in that order. So now think about at 0.05, if the company exits with $1 billion, how much money would I be making on that? Though that's going to be the kind of, you own a part of the company, and the trade-off there is that you are going to be paid less in salary, but you'll get more in equity. This is a share of the company. And the incentive is that when there's a financing round, the value of the company, even though your chunk gets smaller, because the value of the company has increased more than so let's say you have to give half of your shares away, but the value that you use to give half of your shares away is more than the value that you paid for half of the shares. So you're actually increasing the pie, but giving half of the pie away, but you're increasing the pie by more than twice. So you're actually getting the value that you own after the financing round is actually more than you had before. Yeah. Also, the other thing that happens a lot of times is that the direction of the company, when some other investors come on board, changes, and it might no longer be aligned with your values. So you'll have to be careful, like, okay, do I still want to do this? Do I not? And if you don't, are you going to get kind of locked in for some reason? When you get paid with startups, and I think this is still the case, there's actually a difference here. So I put on here. If you work for, I don't know, the big companies, Amazon or not, you get these, they're called RSUs, restricted stock units, in addition, like a bonus. In addition to your normal compensation, you get these, you get shares in the company. And they are called restricted because you cannot sell them right away. So they are assigned to you, but they have what's called a vesting schedule. Do you guys know about vesting? So the vesting is, you have to wait. It's almost like the stock has to mature. So you have to wait, let's say, about 4 years so you get, let's say, 1,000 shares of Amazon, and you have a vesting schedule of 4 years. So that means every year you get 25% of those 1,000 shares. So you get 250 in the first year, 250 in the second, 250 in the third, 250 in the last year. So that's because the company wants you to stick around. So they're like, we'll give you this bonus, but you'll have to stick around for another 4 years to get it, all of it. The part with these restricted share units is that every time they vest, you have to actually pay taxes on them. So if I get 1,000 shares and they vest over 4 years, in the first year I get 250 of them. That is considered income, and I have to pay taxes on that. So that's for the big companies. I think with startups, instead of shares, you get options, specifically call options in a way. So options are contracts that allow you to, it's a contract that allows you to say, hey, I'm going to be able to purchase, the call option is, I'm going to be able to purchase shares at this price. So you have a contract that says you can buy 1,000 shares at this particular price. If the price that I can sell the shares is higher than the price that my contract says I can buy them at, I can actually what's called exercise the shares. So actually exercise the contract. I buy the shares at that lower price, and I sell it at a higher price, and then I can make the spread. So with the shares, when you get them, so with the startup, I would say, again, it has a vesting schedule, and it's a vesting schedule with a cliff, it's called. So it's a vesting schedule that says, let's say same idea, 4 years vesting with a cliff of the first year. So in the first year, you actually get nothing. Then in the second year, you get 50% of the shares. In the third, you get another 25 and another 25. When you get these options, you actually don't have to pay taxes until you exercise them. The shares, I think the tricky part is they stay valid. So the contract is valid for, I think, 10 years if you don't leave the company. If you do leave the company, if you don't exercise them, I think in 3 months, and this is all in our contract. If you don't exercise the shares in 3 months, you lose the options. So if you don't exercise the options in 3 months, you lose the options. So yeah, there's all kinds of trade-offs here from a tax-related point of view. Yeah, so this is the idea with the company grows and you're actually, even though you own less of it, the value of the part that you own is more. And yeah, think carefully. So, okay, if I were to go back and let's say I would still want to join a company, a startup, one thing I would tell myself is like, set a time limit to how long you're going to stay in the startup. If it doesn't, I do remember, Andrew was something like, oh, do we want to, so I was going to go to grad school. I was like, hey, I went to Andrew, I was like, I'm graduating this year, I want to go to grad school, do you have any advice? He's like, oh, I'm starting a company, do you want to join? He's like, okay, I think I will. And he's like, hey, if you join for a year, we'll exit at 10 million. If you join for 5 years, we'll exit at 100 million. I was like, oh yeah, okay. Didn't pan out in any of that way. But if I were to tell myself something, it would be like, come up with a timeline for how long you're going to stay in that particular kind of environment. And if things don't pan out, just literally step out. Just pull the plug and kind of shift to a different direction. Is what happens a lot of times, these startups, they go into somewhat of a zombie mode where the investors keep putting money in, but the path that you chose and the pivots you're making there's very little effect on kind of getting the company to get closer to exit. So you get kind of working for this zombie thing and it's becoming more and more kind of depressing in different ways. So yeah, some cautioner to you. We'll see how things pan out. And a lot of you, I think, are very eager to start something that you build, so you just jump into it without really thinking. From my perspective, and also there's a few. Okay, sorry, his name is eluding me. The Y Combinator founder, Paul. I can't remember his last name. There's one of the Y Combinator founders. He said like he wouldn't start a startup in undergrad. You study hard, understand kind of how the system works, go work for a big company. It's actually, no, maybe I should scratch this. I did observe very successful startups, but these very successful startups were fizzers who knew exactly what the bleeding wound in the industry is. And within 5 years, they're like, okay, we'll build this, they'll need that, we'll solve it for them, and then we'll sell it. If you have that visibility into an industry that you can identify extremely important problems, challenges that you know how to solve, I would say, yeah, just go for it. To have that visibility, though, you have to be an industry expert. And you don't get to be an industry expert in undergrad. So, or maybe you do if you have some internships. Let's say you do internships somewhere over and over again, and you now know you've worked there for 2 years, and you know exactly what that particular company needs, and you have a solution. And the companies love this. Google is all about that. They'll be like, hey, we will actually let you quit. You start a company, you solve our problem, and then we'll buy you. And you kind of take the risk of starting a company, and then they'll come in and kind of. So if you have that visibility, then I think a startup is an excellent idea. If you just want to do a startup because you want to do a startup, I would very, very carefully caution you to think carefully about that. So yeah, here's some notes, some references. This is kind of the course. This is the book that kind of got me to understand why index funds are better than me daily trading and kind of why I'm losing a lot of money. And I'm going to say this is the tricky part. It's like a casino. You make a lot of money, then you also lose a lot of money. In the long run, you lose more than you make. Then I have this the psychology of money. And then on next Thursday, I'm going to talk more about kind of what money is, values and value, kind of what I think is driving all of this, our desires, and how some thoughts about how I think you can stay human in this constantly changing technological landscape. But yeah, sorry. Thank you very much for kind of sticking around, guys. But sorry, there's more questions.
Before we leave, I might just quickly say we have Biz Talks going on in Links 201. So
Okay.
ask your questions to me, but come. It's probably going to be a lot of your guys' last Biz Talks, so come see it. We have free pizza. Yeah. Right now, the free
Okay,
pizza.
go
I'm
eat.
gonna hear your questions. There's
But yeah.
free pizza, so-
What are these Biz Talks?
Biz Talks is our talent show.
Oh wow.
If you-
Is it recorded? No.
If you want, you can come over and see.
I'll pop my head in.
But yeah.
If you guys have, I can email, so I'll email the slides, and also if you have questions, email me. Go for it.